What happens when you throw a dead cat out of the window? Well, it's going to hit the ground violently and probably bounce. Of course, eventually the cat is going to start falling again. It's a fair question to ask whether we're currently in the process of seeing a dead cat bounce on the stock market. The S&P 500 declined by 5% very violently at the beginning of December. Since then, the index has bounced very nicely, but as I'm going to show you in this video, it may not be completely out of the woods. In order to understand what is happening with the US stock market, we need to look at what's happening with the US bond market. Stocks and bonds are highly interconnected with each other and have a significant impact on each other. Stocks and bonds traditionally make up a large portion of investors' portfolio, and money managers and individual investors will adjust their positioning depending on which one is more attractive at any given moment. And today, we're seeing some pretty big shifts happening on the bond market. The yield on a 10-year Treasury note has moved from 3.6% back in September all the way to now 4.6%. So within the last 100 trading sessions, we've seen a 25% jump in the 10-year yield, something that has only happened a handful of times over the last few years. This is a big deal for the stock market because it means that the return on investment you get for owning Treasury bonds has suddenly jumped by a significant margin. Imagine you're a wealth manager and you have a portfolio that you think may be a little bit too exposed to the stock market, and suddenly you see that interest rates on Treasury bonds have gotten significantly more attractive. Well, that could push you to reduce some of your exposure to the stock market and instead get the steady return on investment from US Treasury bonds. And this is exactly why spiking interest rates like we have today can be a risk to markets. In fact, when we look at the last 4 times that we saw a similar move in interest rates to the one that we're seeing today, it was in March of 2022, September of 2022, August of 2023, and April of 2024. If we overlay the S&P 500, the main US stock market index, and see what happened to stocks following these spikes in interest rates, in all 4 of these cases, the S&P 500 experienced some kind of a short-term drawdown. In some cases, just 5% corrections, and in some as much as 10% corrections. Now, before you guys jump to any conclusions, past performance is not indicative of future results. That is a rule to live by when it comes to trading. Each moment in markets is unique, and that's definitely the case today. Let me show you why. Each of these spikes in interest rates were a direct result of the United States Central Bank, the Federal Reserve. The Fed has a tremendous influence on all kinds of interest rates around the economy. We just have to zoom out on this chart of the 10-year yield and add the Federal Reserve's interest rate on top to see this relationship clearly. This line right here is the interest rate that the Federal Reserve controls. They can move it up and down more or less as they wish. And that can have repercussions on all interest rates in the economy, including something like the 10-year bond yield. For example, in 2022, the Federal Reserve raised their interest rate violently, which also caused the 10-year yield to move higher in a substantial way. And that is what makes this spike in the 10-year yield very different, because the Federal Reserve has actually been lowering their interest rate since 2023. What has shifted significantly over the last couple of months, however, is the Federal Reserve's projection of future rate cuts. This is what their 2025 projection of rates looked like back in September, just 3 months ago. And this is what it looks like today. Back in September, they were expecting 6 rate cuts in 2025. Today, they're only expecting 1 rate cut in 2025. And so as a result of this shift in expectations, the 10-year yield has been moving higher. And that's what makes this spike in interest rates different to the ones that occurred in 2022. Back here, the Federal Reserve was raising its interest rate pretty violently. Today, they're really just keeping their interest rate stable. And if we look at the last time that the Federal Reserve kept their interest rate stable like today, that was in the late 1990s, and it coincided with one of the most incredible bull markets we've seen throughout history that fueled the internet bubble. So we are keeping an overall optimistic outlook on the stock market as a result, but we cannot ignore the fact that the 10-year yield is spiking quite violently. This is telling us that there is a risk of a short-term correction in markets as a result, which could actually be quite similar to the one that we saw in April of 2024, for example, where interest rates spiked and the stock market moved down by around 5% before bottoming out and moving higher. In fact, there is another chart that we can add on top of the S&P 500 that gives us a similar warning signal, and that is the price of home building stocks. Home builders are known to be leading indicators of the rest of the market, and during this recent bounce on the S&P 500, home builders have stayed at very repressed levels. If we rewind to March of 2022, we saw something quite similar. The stock market bounced aggressively right here, a period of time where home building stocks were staying at repressed levels, and eventually the stock market did reverse and catch down to home building stocks. So the price action on home building stocks today is also suggesting that the S&P 500 could be due for some short-term pain here. Now, again, we are in a very different situation to March of 2022, and we can see that by adding a few key moving averages on top of the S&P 500. Back here, the moving averages were curling downwards, showing us that the stock market was losing momentum. Today, all the key moving averages are pointing upwards, and the S&P 500 is still above all of them. So to be clear, although we think that there are short-term risks, first of all, we don't have a crystal ball, and even if it does correct, our base case is that the stock market does recover and continue moving higher because of the overall environment that we're in. So we do still have a net long exposure on the stock market today, but we do see some short-term downside risk. For example, a correction to 5,600 points is in the cards here. We sent out a few sell alerts to our clients on some of the long trades that we've been holding over the last few months. We booked a 39% profit on Bitcoin, a 36.7% gain on Ethereum, a 14% gain on Shake Shack, but we've also decided to hedge the rest of our long exposure on the market with a short trade on the S&P 500. We're using a 3 times leveraged short ETF on the S&P 500 to gain plenty of short exposure to stocks to protect ourselves. If you want to follow this trade step by step and have access to all of our other buy and sell alerts on whatever trades we're making, make sure you're subscribed to our website. We've had quite an incredible trading year throughout 2024, and we're very excited to help our clients be profitable in 2025. So make sure you join us.